typically in gold, it would do between 6 and 10,000 contracts. Well, all of a sudden in April, after all this stuff went down, they did like 30,000 gold.
Yeah.
Like, whoa, that's 3 times the normal. What's going on here? And they got that new funky contract allegedly and all that stuff. Then in May for silver, we did like 10,000 silver, which is like the biggest silver delivery month I've ever seen. Then we come back in June, which is now still in the process of delivering June gold. We have over 50,000 June gold. I mean, this is an astonishing amount.
The land of Arcadia.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics, and excited today to have one of my favorite guests on the show. Joining us once again, of course, that is Craig Hemke of TFMR, the TF Metals Report, and especially, geez, with some of the incredible calls. If you guys aren't listening to his weekly call with Eric Sprott, I would highly recommend to do so. Craig, we've covered some of your comments with Eric in these last couple of weeks because certainly some interesting things going on, especially that dealers are calling him like, hey, do you have any 1,000-ounce bars? But either case, great to welcome you back on in here today. And how is everything going with you?
Oh, just fantastic. I still just can't believe it's June. And how, we should go back and watch one of our discussions like from late last year, Chris. It'd be fun to parachute in and say, oh, guess what? By June, here you're going to be talking about, my gosh, what a year we're having. I saw somebody on Twitter say in the future, historians will specialize in the individual quarters of the year 2020. And yeah, I suppose that's probably right. This is crazy.
I mean, it's kind of like you had all the chaos of 2007 and 2008 wrapped up into 3 or 4 weeks, and things happened so quickly. I think it's still sinking in. I think the world is starting to realize that the government's dishing out multi-trillion-dollar packages, and how are they paying that? Oh, yeah, the Fed's going to print it. So, I mean, I wonder how close we are to the point where things get a little out of control, because the Fed last week said basically they're never raising interest rates. Although folks who have been on the TF Metals Report, that comes as no surprise. But Craig, something you've done a great job of covering and we've talked about here a lot are these gold deliveries that are getting kind of massive. So maybe you could start on that and share what you're seeing there.
Yeah, it is a crazy, it fits in with the 2020 theme, right? I mean, it's just crazy. And one of the things you mentioned there was that all this debt monetization, I mean, it's just open now. I mean, I've been doing this for 10 years and we've talked about QE to infinity and never been able to go back. And this idea of normalization of the Fed balance sheet, normalizing of interest rates, all nonsense. I mean, there's no way, man. And on interest rates, you could never have them go up because the cost of servicing the existing debt, it would be so outrageously high. And so you knew all this stuff was coming, and now here it is. And the only real frustrating part about that is the attention span and the focus of people now is so short term that, a lot of this crazy structural, long-term, extraordinarily bullish stuff for the metals and miners just kind of gets lost in the wash every day. I saw a thing on Zero Hedge over the weekend that showed treasury issuance in the Fed balance sheet year to date. Fed has actually monetized 105% of the treasury issuance so far. What?
Of course, they go over 100%, not enough. Just
exactly. How is gold only at what it is, right? Well, anyway, and there's reasons for that, obviously, but long term, big picture, I'd say that's pretty bullish, regardless of what might be happening on any given Monday. Yep. So that's pretty important to focus on. Then you got these structural changes that are happening within the global gold market, and this is really undeniable. And we've seen now. Not just, you and I and, people on the internet talking about this. There have been articles now written in Reuters and Bloomberg and the Wall Street Journal and Financial Times, all about banks that are exiting their activities in the COMEX. They're just not going to jack around with it there anymore. And mainly because they got caught with their pants down. They were just utterly abusing this kind of arcane little feature called the exchange for physical. You mentioned Eric Sprott. Eric, this was back in November of 17. We were talking one morning. We do this thing every Friday, as you said, and we were talking one morning. He said, "Have you been watching these exchanges for physical?" And I said, "Well, not really," because they're going through the roof. It's crazy. The tonnage that they're doing. So in November, I don't know, like November 24th of 2017, I started keeping track of them every day. And you have to do it every day because the CME group only prints them on a rolling 5-day loop. Okay. So if you don't do it every day, it's not like you can go back and say, well, on January 16th of 2019, there were 8,000. No, unless you've been keeping track every day like I have, thanks to Eric, then you can see this. Well, it was just outrageous. The first 2 years, full years that I was keeping track of it, 18 and 19, the total amount of COMEX contracts, 100 ounces per contract, allegedly, right? Though we know that, that's always been a charade anyway. Total amount of COMEX contracts that were moved off the exchange and settled, exchanged for physical in London was like 15,000 metric tons. What? I mean, that's just outrageous. We get into March and it was just over the top. They did something like, what was it? 290 metric tons. No, 290,000 contracts, 900 metric tons in just the first 15 trading days of March. Okay. These banks just abusing this system where they either buy at spot and sell in London, or sell in London or buy in London and sell in New York, to try to, kind of capture the spread between spot and the futures contract. I mean, they're just abusing it and screwing people in the process. QE to Infinity's announced. That whole market just crumbles in a day because there's no actual physical to deliver. Remember, the mines are closed, the refineries are closed, the mints were closed, and some outside party showed up and said, hey, I know where we can get some physical metal. Look at all this exchange for physical stuff that's happened. And some people actually stood up and wanted physical metal. There was, in a sense, really a de facto default that day. The next day, the CME group rushes out this new contract, where they're going to settle in partial ownership of London bars and all these band-aids they put on it. And that volume of these EFPs went from, we had a day that did 38,000 contracts in March. We had a day last week where we did under 1,000. Okay, so these banks have been called to the carpet, that they can't play that game. They can't play that game anymore because there's a lack of confidence in the counterparties. And additionally, there's just a lack of metal to pull it off. And so anyway, long answer to your short question. We are now seeing these trial balloons come out about, and not just trial balloons, but actual reporting with, unnamed sources at Bullion Bank X, that sort of thing, that says these banks are shutting down their trading desk deal in New York. They're working exclusively in London. And then, let's think, back in April, my friend and your friend, Andrew McGuire, told me one morning that he has an old friend who works for Goldman Sachs, that he said Goldman and ICBC are working in collaboration to make a new contract that'll trade on the LME. Mm-hmm. That'll be it'll be a futures contract. It won't be like leveraged 100 times like the COMEX and just be phony baloney, plastic banana, pretend delivery stuff. Still have some leverage to it, but it'll be a complete, let's put opposition or competition to the COMEX. And so, yep. God, long answer, Chris, but yeah, the deliveries on COMEX, it's just not set up to be a delivery vehicle, yep. But they've opened that box and now they're doing 5 million ounces in a month, where they used to do not even 1 million. Big changes are afoot, and it's just all part of the crazy 2020.
I mean, it seems to some degree like someone out there is testing this market. And I'm curious, you've also mentioned and talked in your podcast about how silver deliveries, I guess it starts at the end of this month. And is there anything you can read into yet and see how that might be shaping up or what you're expecting?
Can't really get there yet. I'm looking down to my screen to remember what day it is. Today's the 15th. That July silver will be the next delivery month for the COMEX for silver. And that contract is currently the front month. It's traded. It's got all the volume and all the open interest. And that doesn't go off the board until 2 weeks from today.
Okay.
Options expire in 10 days, Thursday of next week, I think. And so that's going to start to ramp up. Now, I can give you a little history. Typically, the COMEX does 3,000 to 4,000 contracts each delivery month, a couple 100,000 ounces, 5,000 ounces a contract. And typically in gold, it would do between 6,000 and 10,000 contracts. Well, all of a sudden in April, after all this stuff went down, they did like 30,000 gold.
Yeah.
Like, whoa, that's 3 times the normal. What's going on here? And they got that new funky contract allegedly and all that stuff. Then in May for silver, we did like 10,000 silver, which is like the biggest silver delivery month I've ever seen. Then we come back in June, which is now still in the process of delivering June gold. Where we have over 50,000 June gold. I mean, this is an astonishing amount. Because again, the COMEX, they say it's physically backed and there's physical delivery. But if you've watched this stuff every single month, like I have for the last 10 years, you realize it's just a sham. It's an illusion. What typically happens is you get like, 5,000, 6,000 contracts where 1 month the house account at JP Morgan is taking delivery, and that same month the house account of HSBC is making deliveries. And then 2 months later, HSBC takes delivery, and JP Morgan gives it's like this illusion kind of, circle jerk kind of thing where they all just pretend like, they want to make it look like there's actually some physical, because without any physical transactions, then the emperor has no clothes, right? You're just simply trading derivatives with no connection to any physical, which is what they're doing. So they have this charade of delivery. Well, now all of a sudden, again, because of all these shortages and the craziness that really took off in March, they opened the box. They opened Pandora's box by turning COMEX into a delivery vehicle, because that's the only choice they had. Because if people are going to want delivery for a COMEX, what are they going to do? Say no, right? Because if they said no, well, then you get into force majeure and signal failures and all this kind of stuff. So they're at this point fighting a battle, trying to come up with all these different ways to keep the COMEX relevant. They've succeeded thus far. We'll just have to see. Maybe, like I said, these banks are going to maybe start fighting against each other to take power away, and maybe the new contract will do that, and the LME. We'll see. But it is what we're seeing are just historic. I mean, mind-blowing numbers for what is really just a futures exchange in New York.
Yeah, it's some great points you mentioned there, and we'll get to the mind-blowing numbers in SLV. Normally, I report the SLV update every Monday, and those are mind-boggling to me. Although something else you just mentioned, where do the banks start turning on each other? Do some of these shorts head for the exits? I mean, apparently, at least to some degree, there's evidence that started to happen. Bank of Nova Scotia paid a big chunk to exit. I mean, they weren't able to sell their business, paid, and who knows what they really paid to exit that. Then you did a great job of reporting how a lot of the bullion banks, that Reuters piece, take it for what you will, but it seems like some of them are getting scared and nervous. We'll leave aside the anecdotal stuff I hear about some of these things, but I mean, I don't know. It's like when the gold's already rallying and now the Fed basically says we're doing hyperinflation, we're never stopping. I mean, you'd think they should be worried at this point.
Yeah. I mean, if anybody's going to know how fake and synthetic the synthetic gold trading is, how hyper leveraged it is, it's going to be these bullion banks, right? So if they realize that the physical is stretched thin and they're being exposed, for this hyper leverage, well, now wait a second, maybe this isn't such a money-making game after all. Okay. And mining companies aren't hedging anywhere near like they used to 10 or 20 years ago. So they're not really making any money off of that. They got the regulators breathing down their necks finally. The JP Morgan case is just one, but you've got 9 different traders now that have been indicted, not just for spoofing, but like now they're under the RICO statutes as well. The head of JP Morgan's global commodities trading has been indicted, kicked out of the LBMA, all that kind of stuff. So you've got, the legal stuff, the compliance stuff, as any big Wall Street firm or bank compliance departments don't like this stuff, right? Like, wait a second, this is not. And so there's a number of factors that combine, even if you're a bank, a bullion bank that was actually thought you were in it as an honest business. And then you thought, well, you could make a lot of money, like doing these ZFPs where you're going to sell in New York and deliver in London, and capture the spread, the arbitrage, and make a couple of easy bucks per ounce. And that was a gravy train, obviously, for a few years until it just all of a sudden that fell apart. So there are all these things conspiring against the banks just staying in this business. Now, is that good for price? Is that good for us? I don't know. In some regards, think of it like the airline industry, right? If there's 10 airlines, I guess, you get a little better service, or maybe you get a little better pricing, and eventually they all did. Now, what do we have? Delta, United, and American, and Southwest, and you go into some cities where only a couple of them fly into, and you just get bore out, by the cost of it. So maybe cutting back to where it's only Goldman, JP Morgan, ICBC, and HSBC, maybe that wouldn't be good at all. But if anything, these banks that are getting out of the business is kind of telltale about just how fragile that business is at present. And so everybody needs to be following these stories, that's for sure.
Yeah, and something I keep thinking about is, again, from my Wall Street experience, usually anytime any market is hot, you have bankers flocking, as if it's all of a sudden they're doing their pilgrimage to Mecca. Yet here, right as all indications are that there's going to be a lot of customer activity, you would think, as the Fed's hyperinflation campaign continues on and they're running for the exit. So we'll see how that shakes out.
Yeah.
But as I briefly mentioned a moment ago, here's the chart of the SLV holdings, which is just mind-boggling to me. If you even go farther back, it's interesting. Back in 2011, when the price started to fall, we're at 700 million ounces. So at 1292 today, almost doubled since 2011. And we thought, what happened last year when you went from, I don't know, maybe 120 million ounces, I believe that was. Well, that's been blown away this summer. Here you go from 1150, so almost like 150-ish million ounces. I mean, these numbers are historic. I wonder, is the metal actually being placed in there? But it's kind of bizarre that the price would basically be almost flat on the year when you see this much metal going in. So thoughts on this chart here?
Well, there's a couple of them. One, got to remember your custodian for all this alleged silver is JP Morgan. Okay, so let's factor that in, how trustworthy you think they are. All right, that's one of the
And how does that Department of Justice, so they're charging them with the RICO statute. I mean, if somebody wants to lay out, well, they're too systemically important. I mean, I don't know. That's like an axe murderer is too important. But is there at least enough to say, like, these guys should not be allowed to trade COMEX or in the gold and silver business?
Yeah, I mean, or how do you get to do both? How do you get to hold, I can't read, how many million, 1.3 billion ounces of silver? Is that what that says?
Yeah.
And yet you get to run your own proprietary trading desk? How do you not commingle some of this stuff, and journal it around and, write futures contracts against it for your own profit? Who knows what they do, for God's sake, not even withstanding how much of this is actual metal. It's like the GLD, right? The GLD has added, hold on, I should just look. Let me tell you, because I've got it right here on my handy note sheet here. The GLD began the year at, let's see, 893 metric tons. The GLD now alleges to have 1,136 metric tons, and the most since 2013. Wow. Well, what is that? 250 almost metric tons? Where the hell did they get it? Right? I mean, if allegedly gold is hard to find because, all the refineries are shut down and some of the mines, it just makes you wonder, is it just simply promissory notes? like the banks roll in London all the time. You say, I know we got this lease that's going to expire. We got to pay you back, but let's just roll this for another 60 days. So how much of this SLV alleged inventory is just that stuff, like the GLD? So at the end of the day, I think what's good about, exposing and talking about the SLV and the GLD, or what's good about talking about the price and the deliveries and the COMEX and all this kind of stuff, is it gets at least kind of a little more mainstream understanding of this kind of bifurcation of price. You've got this paper derivative trading price that gets quoted on CNBC and Bloomberg, silver, $17.50. And a guy says, oh, okay, that seems pretty cheap. And he goes online to a bullion dealer or goes down to his local coin shop and says, I'd like some of that $17.50 silver. And he gets laughed out the door, right? He's like, well, wait a second, hold on just a minute. It said it was $7. No, I'll sell this to you for $27.50 because that's what the current spot, that's versus spot with premium and all this kind of stuff. And the short is, so what is really the price? And that's one of the more positive developments, like I said, to come out of this, is getting people to realize, well, wait a second, this futures price, that's not the price I pay.
Right.
And get you to realize that there's really no connection between physical supply and demand and this derivative derived price. There's really none. What you're seeing in the derivative is the supply and demand of the derivative that sets the price. And anyway, the more people that realize that, the better, and moves us further along that path to getting some kind of change into how price is determined.
Yeah, and certainly you've been one of the leaders in helping to share that awareness. So that was part one of the interview with Craig Hemke. If you enjoyed that, go ahead, hit the subscribe button and the notification bell, and that way you will be posted as soon as part two is released, which I think you're going to want to hear because he talked about how he sees this all ending, as well as some other fascinating things that are happening with the silver market. So hit that subscribe button and part two will be coming your way shortly.